Hello and welcome to Share Market Secrets, the channel where we uncover the truths behind the stock market. In this video, we'll be discussing some common myths and misconceptions about the stock market and how they can affect your investing decisions, with a focus on the Indian stock market. Myth number 1: the stock market is a gamble. Many people believe that the stock market is like gambling, where you have to rely on luck to make money. But in reality, investing in the stock market is a long-term strategy based on sound research and analysis. The stock market is driven by a company's fundamentals, such as its revenue, profits, and growth prospects. By researching and analyzing these factors, you can make informed investment decisions. For example, let's take the case of Reliance Industries, one of the largest companies in India. If you had invested 10,000 rupees in Reliance Industries in 2008, your investment would have grown to 3 rupees and 30 paise lakhs in 2020, a return of 3,300%. Myth number 2: you need a lot of money to invest in the stock market. Many people think that you need a lot of money to invest in the stock market. But in reality, you can start with as little as 500 rupees. The key is to start small and gradually increase your investment over time. For example, let's say you invest 500 rupees every month in the stock market for 30 years and earn an average annual return of 12%. At the end of 30 years, your investment would be worth 15 rupees lakhs. Myth number 3: the stock market is only for experts. Investing in the stock market is not just for experts. Anyone can learn how to invest by doing research, attending seminars, and reading books. It's important to understand the basics of investing, such as how to read financial statements, evaluate companies, and diversify your portfolio. For example, Rakesh Jhunjhunwala, often referred to as the Warren Buffett of India, is a self-made billionaire who started his career as a chartered accountant. He went on to become a successful investor by following a disciplined investment strategy and doing thorough research before making investment decisions. Myth number 4: the stock market is a get-rich-quick scheme. Many people believe that the stock market is a get-rich-quick scheme, where you can make huge profits overnight. But in reality, the stock market is a long-term investment strategy that requires patience and discipline. It's important to stay invested and not panic when the market goes through temporary ups and downs. For example, Ramesh Damani is a well-known Indian stock market investor who started investing in the stock market in the 1980s. He believes in the power of compounding and has built his wealth over time by staying invested in quality companies. Myth number 5: you need to constantly trade in the stock market. Some people think that you need to constantly trade in the stock market to make money. But in reality, frequent trading can lead to higher transaction costs and taxes, which can eat into your profits. It's important to have a long-term investment strategy and hold on to quality stocks for the long term. For example, Radhakishan Damani, the founder of Mart, is one of the richest men in India. He started investing in the stock market in the 1980s and has built his wealth over time by holding on to quality companies for the long term. Now, let's talk about some people who have become millionaires from poor backgrounds through the stock market. Rakesh Jhunjhunwala is a well-known Indian investor who started with only 5,000 rupees and has since become a billionaire through his investments in the Indian stock market. Another example is Radhakishan Damani, who started his career as a trader in the Bombay Stock Exchange and later founded the retail chain D-Mart. He is now one of the wealthiest people in India, thanks to his investments in the stock market. These examples demonstrate that the stock market can be a powerful tool for building wealth, even for those who may not have had significant financial resources to start with. However, it is important to remember that investing always carries risks, and it is important to approach the stock market with caution and a well-informed strategy. Let's look at one investment calculation example. Let's say you invest 100,000 rupees in a stock that grows at an average rate of 12% per year for the next 20 years. After 20 years, your investment would be worth approximately 932,190 rupees. This is calculated using the formula future value equals present value x, 1 plus rate of return, number of years. In this example, the future value would be future value equals 100,000 rupees x, 1 plus 0.12, 20 future value equals 932,190 rupees. So, by investing 100,000 rupees in the stock market and holding onto it for 20 years, you could potentially increase your investment almost tenfold. Of course, this is just an example and the actual returns on your investments may vary. In conclusion, investing in the stock market is a powerful tool for building wealth over the long term, including in the Indian stock market. By taking a long-term approach to investing, doing your research, and staying disciplined, you can achieve financial success and create a better future for yourself. Most importantly, I've provided some great resources and study materials in the description below to help you better understand the stock market and make informed investment decisions. Thanks for watching this video on share market secrets, and we'll see you in the next one.